Ask Carlo, private equity, simplified.
37 kilometers beneath the English Channel, at the deepest point of a tunnel that connects two nations, a Eurostar train hurtles through chalk at 160 kilometers per hour. Above it, one of the busiest shipping lanes on Earth. The Channel Tunnel is one of the greatest engineering achievements in European history, but financially, it was one of the most spectacular disasters of the 20th century. The budget doubled, the debt spiraled to 9 billion euros, the company collapsed twice. Original shareholders lost nearly everything, diluted by 97%. And yet, today, a company that owns it, Getlink, is worth over 10 billion euros. It generates 860 million euros in operating profit. It pays dividends. How does the greatest financial failure in European infrastructure history become a 10 billion euros success? That is the story of infrastructure investing, and it starts with patience. This is Ask Carlo, Private Equity Simplified. I'm Carlo Schneider. Last episode, we followed Jimmy Choo through 4 private equity owners in 16 years, each adding value, each making money. The relay race of secondary buyouts. Today, we leave the fashion industry behind us. We are going underground, literally, into the world of infrastructure investing, where the time horizons are decades, the assets are essential, and the rewards favor those with extraordinary patience. Quick disclaimer, everything I share is educational only. This is not investment advice. I'm not recommending you buy anything. I'm showing you how professional investors think. If you're new, subscribe. Every Tuesday, one real deal explained clearly. The idea of connecting Britain and France beneath the sea is centuries old. Napoleon considered it. Victorian engineers sketched it. But politics, wars, and sheer technical audacity kept stopping it. Then, in 1986, British Prime Minister Margaret Thatcher and French President François Mitterrand signed the Treaty of Canterbury, the agreement between the British and French governments that would finally make it happen. But with one non-negotiable condition: not a single pound or franc of public money would be spent. The entire project would be privately financed, no government subsidies, no taxpayer guarantees. This was unprecedented. No privately financed infrastructure project of this scale have ever been attempted. A company was created, Groupe Eurotunnel, listed simultaneously on the London Stock Exchange and the Paris Bourse, France's main stock exchange. The financing was ambitious, roughly 1.2 billion euros in equity from over 700,000 small shareholders, mainly of them ordinary citizens in Britain and France who believed they were investing in future. On top of that, a syndicated bank loan of roughly 6 billion euros from 220 banks. The budget was 5.5 billion euros. The construction consortium TransManche Link, a joint venture of 10 British and French construction companies, began digging in 1988. And almost immediately, the problems began. Think of it like renovating a house. Your budget is 100,000 euros. Halfway through, you discover the foundations need replacing. Then regulations change and you must install new safety systems. Your builder is behind schedule and charging penalties. Your bank is nervous. By the time you finish, the bill is 200,000 euros and the rental income you expected is half of what the estate agent promised. That is precisely what happened to Eurotunnel, except the numbers had 9 zeros. The construction cost doubled. Mid-project, safety regulations demanded wider doors, stronger fire protection, and an advanced anti-terrorist system. Equipment was late, testing took longer than planned, cost spiraled. By the time the tunnel opened in 1994, the final bill was over 11 billion euros, double the original estimate. But the cost overrun was only half of the problem. Eurotunnel had assumed that passengers and freight would flock to the tunnel, that the ferry operators would quietly accept defeat. The reality was the opposite. The ferry companies slashed prices. A brutal price war erupted across the English Channel. Revenue projections that had underpinned all those loans turned out to be widely too optimistic. In the first full year of operations, 1995, Groupe Eurotunnel reported a loss of roughly 1.1 billion euros. The company was carrying over 9 billion euros in debt, and there was simply not enough revenue to service it. In September 1995, Eurotunnel suspended its debt payments. The company was, for all practical purposes, insolvent. Now here is where the story takes its crucial turn and where the logic of infrastructure investing begins to reveal itself. The tunnel could not go away. It was 50 kilometers of concrete and steel under the seabed connecting two of the world's largest economies. Trains were running, passengers were traveling, freight was moving. The asset was essential. It simply had the wrong financial structure on top of it. The first restructuring came in 1997. Debt was reorganized and both governments extended the operating concession, means the right to run the tunnel commercially, from the original 55 years to 99 years, pushing it to 2086. This was critical. More time to earn revenue meant the math could eventually work. But it was not enough. The debt burden remained crushing. By 2006, the company was placed into bankruptcy protection by a French court. Then, in 2007, the decisive restructuring. Three major investment banks, Deutsche Bank, Goldman Sachs and Citigroup, stepped in with 3.3 billion euros of a new long-term funding. Roughly 4 billion euros of old debt was written off. The original shareholders were diluted by a factor of 40 to 1. If you owned 40 shares, you now held 1. It was brutal for those original 700,000 investors. Many had bought shares at the equivalent of 4 euros or more. After the restructuring, those shares were worth pennies. But in 2007, for the first time in its history, Eurotunnel reported a net profit. Just 1 million euros, modest but symbolic. The patient recovery had begun. Have you ever traveled through the Channel Tunnel by Eurostar or with your car on the shuttle? I'd love to hear about it in the comments. The company rebranded as Getlink in 2018. Today it operates through three segments: the tunnel shuttle services, a rail freight business called Europort, and ElecLink, an electricity interconnector that runs through the tunnel, selling power capacity between Britain and France. A tunnel that carries trains and electricity, clever diversification. In 2025, Getlink generated revenues of 1.6 billion euros and an operating profit EBITDA of 859 million euros. The company targets 1 billion euros in EBITDA by 2030. It is listed on Euronext Paris, the French stock exchange, and it's worth today over 10 billion euros. It pays a dividend of 80 cents per share. From financial collapse to a dividend-paying European infrastructure champion. The pattern repeats across infrastructure. Vinci, the French construction and concessions giant, operates motorways and airports across Europe under long-term concessions with stable inflation-linked revenues. Macquarie, the Australian investment bank that pioneered infrastructure fund investing, built a global portfolio including airports, toll roads, and utilities. The principle is always the same: essential assets, long concessions, patient capital. But let me be balanced. For the original Eurotunnel shareholders, those 700,000 individuals who believed in the dream, this was a disaster. They lost nearly everything. Infrastructure investing rewards patience, but it punishes also those who get the price wrong, who underestimate risk, or who enter at the wrong point in this circle. The tunnel was a triumph of engineering, the original financing was a catastrophe of optimism. That distinction is the most important lesson of this episode. Let's decode today's term concession. In infrastructure, a concession is the right granted by government to a private company to build, operate and profit from an essential asset for a fixed period of time. When the period expires, the asset returns to the state. Think of it like a vineyard lease in Burgundy. The land belongs to the appellation, but a winemaker secures a 50 years lease. During those 50 years, they plant the vines, harvest the grapes, sell the wine and keep the profits. But they must maintain the vineyard in excellent condition, and when the lease ends, the land goes back. Eurotunnel's concession was originally 55 years. After the restructuring, it was extended to 99 years, running till 2086. That extension was worth billions because it gave the company 44 additional years to earn revenue from an asset that will not become obsolete. People will always need to cross the channel. The concession is what makes infrastructure investing distinctive. You're not buying a company that might be disrupted by technology or fashion. You're buying a contract that guarantees access to an essential service for decades. This week's question comes from Henrik in Copenhagen, who asked, why would anyone invest in infrastructure when the return seems lower than other types of private equity? That's a great question, Henrik, and hi to Copenhagen. It is true that infrastructure typically generates lower headline returns than leveraged buyouts or venture capital. A strong infrastructure fund might target 8 to 12% per year. A buyout fund targets 15 to 25%. But here is the difference: predictability. A motorway concession guarantees toll revenues every single day. An airport collects landing fees from every single flight. These revenues are often linked to inflation, meaning they rise as prices rise, protecting your purchasing power. Compare that to venture capital, where 7 out of 10 investments may fail entirely. Infrastructure is not about spectacular returns. It is about reliable inflation-protected income over very long periods. For pension funds, insurance companies, and family offices that need to match long-term obligations, that predictability is extraordinarily valuable. Lower returns, lower risks, longer durations. This is the infrastructure trade-off. And for certain investors, it is precisely what they need. Let's look at one metric that is fundamental to infrastructure investing: enterprise value to EBITDA. This ratio tells you how many years of operating profit you are paying for when you buy an asset. A lower number means cheaper. A higher number means the market is willing to pay a premium for the quality and predictability of those cash flows. For Getlink, the enterprise value is roughly 10 billion euros. The EBITDA for 2025 was 859 million euros. So investors are paying roughly 11.6 times annual operating profit. That is a typical range for infrastructure between 10x and 15x. Compare that to the luxury goods sector, where companies often trade at 20 or even 25x EBITDA, or technology where 30x or more is common. Why do infrastructure assets trade at lower multiples? Because their growth is slower. But their cash flows are more predictable, more resilient, and often inflation-linked. You pay less, but you better sleep. And the concession running to 2086 means Getlink has 60 years left of revenue ahead of it. Patient capital. So here is the insight. The Channel Tunnel was a catastrophe for its original investors, but the asset itself was never the problem. It was essential, irreplaceable, and growing. The problem was the price paid, the debt piled on top, and the widely optimistic forecasts. Infrastructure investing rewards patience, not optimism. The asset always had value. It just needed the right financial structure and enough time. Subscribe. Share this with someone who has taken the Eurostar and who wonders how the great infrastructure projects of Europe actually get financed. And send your questions to the link in the description. Next episode, Aman Resorts. Hotels so exclusive they cost 5,000 euros a night and so discreet most people have never heard of them. How do you finance the world's most luxurious hotel brand when banks will not lend against something as intangible as exclusivity? The answer is private credit, and the story is remarkable. Remember, this content is educational only, not investment advice. Always consult qualified professionals. Stay sharp. Ask Carlo.
Ask Carlo. Private equity simplified.